Welcome to the Deep Dive. Today we are tearing into the Q3 fiscal 2025 earnings call for Zumiez Inc.
That's ZUMZ.
Exactly. And for a specialty retailer that's, weathered some significant volatility, ZUMZ didn't just meet expectations this quarter.
No, they absolutely obliterated them.
They really did. And this deep dive is necessary because the sheer magnitude of the beat, plus a major outlook raise, it suggests we're not just seeing like a cyclical high point.
No, this could be a real structural inflection for the company. It was certainly the biggest story in youth retail this week.
So our mission today is to really understand the core drivers behind that Q3 beat.
And dissect that surprising acceleration in North America, yeah. We also need to figure out what management's surprisingly cautious guidance for the holiday season really means for investors. Is this repeatable? That's the key question.
Let's jump straight into those headline numbers because they were pretty staggering. Net sales for the quarter came in at $239.1 million.
Which is solid growth. That's up 7.5% year over year.
Right. And it surpassed the consensus forecast by almost $5 million. But the real leverage, the real story came further down the income statement.
And that sales strength was critical because it was broad-based, even if it was, geographically a bit uneven. Global comparable sales grew 7.6%.
And that's the sixth consecutive positive comps quarter. That's real momentum.
For sure.
But the key distinction, and this is where it gets interesting, is where that momentum came from. When we break down the comps, North America it accelerated dramatically.
We're talking a robust double-digit gain of 10%.
10%. And this is happening while so many other specialty apparel retailers are, frankly, struggling to even stay flat.
And that North American success stands in sharp contrast to the international business. Comps across Europe and Australia actually declined by 3.9%. This regional divergence is absolutely critical. It tells you the strategy that's working is localized, but it also shows their global ops are still facing some pretty significant headwinds.
Right. So if sales were the appetizer, the EPS was the entire feast. GAAP EPS hit 55 cents.
And the consensus was a meager 27 cents.
It's a truly massive beat. Even if you account for the, 9 cents from a one-time tax benefit?
About that, yeah. Even without it, the core operational performance just far exceeded what anyone on the street expected.
And the market responded immediately.
Instantly. That kind of beat, combined with the optimistic tone for management, caused the stock to jump over 12%.
And on huge volume, too, roughly 3 times normal.
Which is the market effectively validating this whole structural repair job. They're saying, okay, this wasn't just a good quarter. This looks like you're tightening the screws on the entire operating model.
So if they are tightening the screws, that takes us right to the quality of these earnings. They weren't just selling more stuff. They were selling it at a much higher margin. So let's transition into those profitability drivers, starting with the biggest headline, gross margin.
Gross margin expanded by a significant 240 basis points year over year. It landed at 37.6%.
Okay, for those unfamiliar with the retail jargon, 240 basis points is 2.4%. That is a phenomenal amount of leverage in this industry.
It's huge.
So let's unpack that.
Yeah.
The key isn't just the number, but understanding the levers that drove it. What were the main factors they detailed on the call?
Okay, so the first and the largest chunk was pure efficiency. They got 110 basis points of leverage just from store occupancy costs.
So that's the payoff from closing underperforming stores.
Exactly. Higher sales volume flowing through their existing stores, combined with those strategic closures, means their fixed costs are just being spread over a much healthier revenue base.
So they're literally leveraging the fixed costs of their remaining stores better. What was the second driver?
The second was 100 basis points of improvement in product margin. Management attributed this to, and this is a direct quote, disciplined full price selling.
Hold on. Disciplined full price selling sounds like, standard corporate jargon. Does that just mean they stopped running sales? Or does it mean the product is genuinely so much better that people don't wait for a sale?
Based on all the other commentary, it really seems to be the latter. They're saying the product mix is just hitting the mark perfectly.
I see.
When customers are willing to pay full price, it tells you the buying team is executing flawlessly. If they just stopped promotions without great product, sales would have plummeted, which, didn't happen in North America.
That makes a lot of sense. And what about the final piece of that margin puzzle?
A smaller, but still very meaningful, 30 basis points came from lower inventory shrinkage.
Which again suggests tighter operational controls, better management.
Yep, all around.
So you combine those factors, lower fixed costs, much better product margin, tighter inventory, and what do you get? Operating income surged to $11.8 million.
Raising the overall operating margin from just 1.1% last year to 4.9%. It's a huge swing.
And on top of that, SG&A expense decreased by 140 basis points, mostly from wage leverage on those booming sales.
And what's fascinating here is the sheer financial stability underwriting this whole thing. They closed the quarter with over $100 million in cash and marketable securities.
And critically, zero debt.
Zero debt on the balance sheet. This isn't a company just surviving. They are thriving and aggressively rewarding shareholders. They spent over $38 million year to date to repurchase 2.7 million shares.
It's a very clean balance sheet supporting a really aggressive pivot in strategy. So let's pivot to that strategy. The CEO called this the best third quarter in several years, and the root cause seems to be product control, which leads us directly to the game changer. Their private label brands.
The numbers here, I mean, they represent a wholesale strategic transformation. 5 years ago, private label penetration was around, 11 to 12% of product sales?
Right, pretty standard.
Management confirmed that private label is now nearly 31% of total product sales. To jump to almost a third of your sales being your own product in that time frame is extraordinary.
That is not an incremental adjustment. That's a fundamental shift in the business model. Why does 31% matter so much?
Well, two reasons. First, margins. Obviously. They have way better control, which leads directly to that 100 basis point gain we just talked about.
And second?
Second is trend stability. It minimizes their dependency on the volatile cycles of external brands. And get this, management even noted that in several of their private label categories, they are positioned as the premium price player.
So their own brands are seen as a destination, not just a cheaper alternative.
Exactly.
And this structural margin story is being perfectly complemented by a massive cyclical rebound in a core category, skate hard goods.
Yes. The soul of the Zumiez brand.
And it's been brutal for years, right?
Oh, brutal. We're talking 4 painful years of massive declines in decks, trucks, wheels, all of it. It dates back to the 2020 pandemic peak when everyone rushed outside to buy gear. That created a deep trough.
But the call confirmed the reversal. Skate hard goods delivered strong double-digit comps in Q3.
And it was actually the leading category for sales performance at the start of Q4.
So this isn't just a bump.
Management framed this as the long-awaited turn. They're signaling this could be a new, multi-year positive cycle. And when you combine structural margin improvements from private label with a huge cyclical tailwind in a core category like skate,
that's when profitability truly explodes. And across the mix, women's was the largest positive comping category, then hard goods, then men's and accessories.
Footwear was the only negative, which tends to be super competitive and really dependent on those big external brands.
Okay, but we can't talk about all this North American strength without hitting the counterpoint. While the U.S. and Canada are firing on all cylinders, international is still weak.
Comps down 3.9%. And you need to understand the strategic thinking here.
So what's the deal with Europe and Australia?
Management was pretty transparent. Europe continues to face challenging market conditions, sustained inflation, hitting discretionary spending, a much more promotional environment.
Where it's just harder to charge full price.
Exactly. Their peers are all heavily discounting.
Yet, Zumiez is refusing to chase that.
Precisely. They are accepting the low single-digit comp decline they're projecting for Q4 internationally because they are laser-focused on preserving margin.
So they're choosing value over volume in Europe.
They are. They stress they're maintaining full-price discipline and are actually seeing product margin gains even with the softer top line there. North America is delivering both volume and value, but in Europe, they're choosing value.
This strategic discipline is perfectly reflected in the forward guidance, right? Let's connect that blowout Q3 to their holiday outlook.
The Q4 guidance was a strong raise. They're forecasting net sales between $291 and $296 million. That's 4 to 6% growth.
And for comps, they guided to 2.5 to 4% globally.
But they gave a very specific breakout for North America.
Right, which they expect to lead the charge at 4.5 to 6.5% comps.
And their operating margin guidance is a tight but impressive range of 8 to 8.5%. EPS between 97 cents and $1.07.
Compared to 78 cents last year. A big jump.
And this dramatically changes the whole full year outlook. They're now forecasting full year sales growth of 4.5 to 5%. And the profitability swing is the biggest story. From a loss of 9 cents last year to a projected profit of 57 to 67 cents this year.
That is the proof that the repair job is working. And they're achieving this sales growth despite strategically shrinking their store footprint.
Yeah, that's a key point. They have 54 planned store closures across fiscal 24 and 25. That's a $15 million sales headwind they are just willingly absorbing.
It's a powerful signal. They're pivoting away from that old mall model.
And becoming an asset-light, mix and margin-driven retailer. They're taking a short-term hit on sales, but every poor-performing store they shed raises the average profitability of the whole chain. That's why the margins are flying.
Which raises an important question the market's grappling with. If Q3 was a massive beat, and we know Q4 comps were already up 6.6% through early December, why is the overall Q4 guidance set so, modestly at 2.5 to 4%?
It comes down to classic management conservatism. They said they were balancing the phenomenal November trends, which included a very strong Black Friday period, with near-term conservatism due to macro uncertainty and softening traffic outside of those peak periods.
That tells you exactly what the market is pricing in right now. That 12% stock pop is a direct bet that this guidance is beatable.
For sure. Investors are pricing in sustained momentum in North America that management's cautious tone just doesn't fully reflect, especially given that these hard goods cycles tend to run for multiple years once they get going.
Okay, time to put on the hedge fund analyst hat. And the standard disclaimer: this is not investment advice.
Nope.
This is purely an exercise in connecting the strategic dots and dreaming up an outrageous but plausible trade.
We're just analyzing the mechanics of the market reaction here.
The thesis is simple. The market is still valuing Zumiez like a cyclical, volatile mall retailer, not a higher margin, private label leveraged brand platform. The combo of that 31% private label penetration and the accelerated store closures means this company's earnings power is just fundamentally different now.
So you're arguing the leverage they're gaining from the shrinking store base is being underestimated.
Absolutely. So the trade idea would be to buy ZUMZ stock outright, but then pair it with long-dated call options, say 18 months out. We're betting on the continuation of this asset-light, margin-focused strategy. And we're betting that the company will aggressively deploy that huge cash pile and zero debt position through even more share buybacks.
And what's the specific catalyst you'd be targeting for that re-rating?
The catalyst is betting that private label penetration crosses 35% in fiscal 2026, combined with the skate hard goods cycle running hot all through 2025.
I see.
If North American comps maintain mid to high single-digit growth and international just stabilizes, that full-year EPS guide of 57 to 67 cents is way too low. The private label mix forces a structural re-rating of the stock. We're basically betting that conservative guidance gets completely crushed.
It's a strong thesis based entirely on that shifting gross margin profile and balance sheet strength.
So to recap our deep dive, Zumiez is executing a multi-quarter repair job focused relentlessly on mix and margin. This led to an overwhelming EPS beat in Q3.
Driven by 240 basis points of gross margin expansion, huge growth in high-margin private label, and that crucial cyclical turn in their core skate hard goods category.
Right. And the market believes the recovery is structurally sound, even if management is, preaching a little bit of prudence.
That operational efficiency combined with the private label momentum, it just creates a much more resilient model.
So what does this all mean for you? Here's a final provocative thought to mull over. Zumiez's success relies on maintaining this delicate balance between its core branded identity, the external brands that draw customers in, and the rising profitability of its own private label products. As private label climbs towards, say, 35%, what happens to margins when the inevitable next brand cycle hits the market? Will Zumiez be able to pivot fast enough to adopt that new hot brand, or will they cling to their high-margin private label too long and maybe sacrifice relevance for profit?
That tension right there between high-profit private label and trend-relevant third-party brands is the defining challenge for their management team going forward.
Thanks for joining us for this deep dive into the Zumiez Inc. Q3 FY25 earnings call. We encourage you to continue following the analysis.